Hello, everyone, and welcome back to the podcast. Jacob here. We just had an exciting guest, Jonathan Brabrand, a team member here at Transact Capital and also the author of the $100 million exit. We talked about business valuations. It's a question we get all the time. You're going to want to tune in and listen to his insights. All that and more, so let's dive in.
Transact Capital presents Banking on Your Business with Jacob Robertson.
Good. Well, Jonathan, good afternoon. Great to have you in here. And so we started this, like I said, initially we were going to have, guests come in and our goal is to equip business owners with the right information to maximize their exit. Mm-hmm. So we let other people come in and tell great stories, but it really excites me when we get to have our team come in and tell their stories. So we'll take a second here, let you introduce yourself, and then we'll dive into a really good conversation.
Sounds great. Well, Jacob, thank you so much for having me. My name is Jonathan Brabrand. I'm a managing director here at Transact Capital Partners. And I've dedicated the last 25 years or so of my career, really the entirety of my career, at helping business owners think about preparing for and ultimately exiting their business.
Great. Yeah, great. And so one thing I do want to say, and I have it here, I'll make sure to get it in the camera. This was the first book I read when I showed up, and this is your book. So it's called The $100 Million Exit. So real quick, give us a quick, summary of what that is. And then like I said, we'll dive into the conversation.
Yeah, absolutely. I wrote that book just a couple years ago, and the target is really business owners who are in a position of thinking about a future exit. And a lot of times business owners don't think about that future exit soon enough. And so part of the reason for the book was to give them a goal or something to shoot for. If you wanted a big home run, $100 million exit, what would that look like and what should you be doing? And so really it's divided into three sections. The first section can be utilized by business owners really at any time. Whether their exit is in the near term or far off in the distance, it's got some really tactful things that they can be doing, tactile things they've been doing to help prepare for a future exit. The middle talks about the actual process itself of selling a business, and then the last part talks about when you're in the final stages of discussions with the buyer, what are some things that you look for?
Great. Yes. And so I know we talk about this, and this is what we want to dive into. What's the most consistent, most often question you get asked or we get asked is business valuations.
Yep.
That really starts the conversation, and you can't blame business owners. That's what they want to have in mind, and
yep.
It's a simple question to ask. It's a hard question to answer.
It is.
So we'll try and answer that today. So
yep.
Just wanted to start the conversation off. When someone comes to you and says, "Hey, what's my business worth?" Walk us through your thought process and how you kind of carry that answer out.
You're right. It's probably the question we get the most often, and one that we can understand certainly why that's on the top of business owners' minds. A public company is a very simple question to answer. What is Apple worth? What is IBM worth? You can look at their stock price and know on a daily basis exactly what investors think that those businesses are worth. It's not so easy for a private company. It's really a combination I found over my career of an art and a science. And there is certainly a scientific element to it. That part of it revolves around analyzing the cash flow of the business and what that cash flow might be worth to potential investors. It looks at there's like four basic models that we use to come up with a dollar value of the business on the scientific side of this question around like what are public companies in the sector trading for in terms of a multiple, what have past businesses in the industry sold for, kind of like comps in the real estate market. A traditional DCF model, discounted cash flow model, that just looks at what are the future cash flows that are expected from this business, and discounting those back at a risk adjusted rate to factor in perceived risk in that business. And then there's a fourth one that we use, which is a leveraged buyout model that basically looks at what an investor might be able to pay for a business and get the return that they're looking for.
Okay.
Those are all very common models that business buyers use pretty consistently, and they will come up with a pretty consistent range of value for a given business. The art of it is really how we kind of earn our living is helping find those buyers that are willing to go beyond just what the basic arithmetic would say a business is worth, and pay more for it.
Right. Yeah. So let's dive into that. Yeah. And then I think that's what is really interesting is like you said, what are the factors? What are things that they can actually control? And really, what are things they can do 2, 3, 4 years out to start getting ready for that valuation? And it might not make sense to them now, but when you think of, okay, well, I'm going to sell this company, what are those things that you think that they should work on?
Absolutely. Well, there's really, if you think about the basics of a DCF model, discounted cash flow model, you've got a string of cash flows, and then you've got the risk-adjusted rate at which those are discounted back. And that again is designed to factor in the risk that's perceived in those stream of cash flows. To increase the value of a business, you can impact either of those variables. And the one that everyone thinks about and the easiest one to understand is just making those cash flows bigger, right? Grow your business. The bigger a business is, the more it'll be worth. That makes perfect sense. Having a larger stream of cash flow will, of course, be more valuable. And there are ways that we could talk about doing that. And business owners are largely focused on growing their businesses and making their cash flows bigger. The one that I think business owners often overlook, though, is that second component, and that is the risk-adjusted rate or the riskiness of that stream of cash flow. And essentially, if business owners can reduce the perceived risk in their business from an outside third party, their business will become more valuable by definition.
Yeah.
And so it's thinking about what are some aspects of my business as a business owner that maybe I've gotten comfortable with. I don't see them as that risky, but a buyer would perceive them to be risky. And this is where you hear things like recurring revenue is super valuable. That's because it's perceived to be less risky. That's where you hear you don't want to have customer concentration. You don't want to have one customer be 30, 40, 50% of your business, which sometimes we see in smaller businesses. That's because that's perceived to be risky. If that client walked away, you'd lose half your business. So diversifying your customer base is another one. There's a slew of things around depth of management team and making sure that there's not key man risk in one particular individual, be it a salesperson or an owner. Vendor concentration. So we talked about customer concentration, recurring revenue versus project revenue. Anything that you can do as a business owner to step back and think about if someone outside was looking at our business and they wanted to hone in on what are the riskiest elements of it, identifying those and finding ways to reduce that risk will make the same stream of cash flows more valuable.
Great. Yeah. That was a great answer. And what about, so that's internal stuff that people can work towards. And you kind of talk about this in the book. What about external factors? Do you think about like rising rate environments, things that are really truly outside of your control, but it is the reality that we're working in. How do you proceed with that? What is your advice towards business owners when they're considering external factors?
Absolutely. So thinking about that plays into timing, which is another question that we get a lot: is when's the right time to sell my business? And implied in that question is when's the right time to sell to maximize the value of my business.
Correct.
So the two topics go hand in hand. The basic answer to the question of the time to sell a business is really around monitoring three different aspects. Very simple to keep an eye on. And when at least two or the three of those are hitting on all cylinders, it's probably a good time to sell. The first one is the M&A market. So just like you'd want to sell a house into a hot real estate market, you want to sell a business into an active M&A market. Now that is to some degree influenced by interest rates, which you mentioned, but probably not as much as people think. Ultimately, deals are getting done in higher interest rate environments the same as they are in lower. Multiples might be compressed a little bit. Valuations might be compressed a little bit when interest rates are higher. But it's been a very active M&A market for the last decade or so, and even in this interest rate environment, I think that M&A activity will continue. So to some degree, the M&A market gets a check based on the activity that we're seeing here at Transact and our other industry participants are seeing as well. The second factor to think about is the industry and the timing of where your business's industry is in its kind of long-term ebbs and flows. We talk a lot here at the firm about it's much harder to sell an A-plus company in an out-of-favor industry than it is to sell a B-plus company in a hot sector. The sector is going to outweigh the qualities of the individual company. And that's basically because business owners or business buyers are betting on the fact that the industry is a more powerful influence than any particular company. It's going to be hard to consistently outperform an out-of-favor sector over the long term. And so, oil and gas is a typical one. When oil and gas prices are really high, any business that touches oil and gas. They could be moving workers to and from the oil rigs or anything related to it, are going to get a higher multiple. When the price of oil drops, you can't give away an oil field services business, as an example.
Right.
So look, for a business owner to step back and think about, where is my industry headed? Is it growing? Is it shrinking? Are there big external factors that are going to be a threat to our industry writ large? And thinking about how an outside investor might think about where we are in a given cycle. That's something to think about. You want to sell a business when the industry is growing, expanding, and doesn't have a lot of negative external pressures affecting the industry as a whole.
Okay.
And then the third one is where is our business itself in its growth path. And the simplest thing here is you want to sell a business in its sort of sixth or seventh inning, to use a baseball analogy,
right, okay,
rather than the ninth or an extra innings. And that's tough for business owners sometimes. Sometimes they hold on too long and the business is plateaued, they've lost interest, they're slowing their pace a little bit, their activity in the business, and the business starts to taper off. You're going to start to have your valuation suffer when that happens. You want the business to be having a good period of historical growth, the early innings of the baseball analogy, but you want to have some growth left on the table that you can point to the buyer and say, this is what's ahead of this business that you're going to be able to benefit from. Buyers are buying the future, right, not the past. And so it's great that you had your best ever year last year or the year before. That's good for you, but it's not good for the buyer. The buyer wants to know what's next year and the second year and the third year of my ownership going to look like. And so having growth ahead of the business is really, really important, and making sure you don't hold on to the point where the business has started to plateau.
Yeah, well said, and that's great. And so from your point of view, I would be curious to get your perspective on, what. So we talk about valuations, and ultimately, it's what the closing price is, and how have closings gone recently? And so, kind of walk us through from your point of view. Like I said, right after COVID to where we are 2-3 years later. What are you really seeing at that final closing stage?
Yeah, we've seen a couple different things where it relates to valuation and also the structure of the deal offer itself. So in valuations, coming out of COVID and even during COVID to some degree, there was a lot of focus on what's sustainable. And what are the ongoing earnings of this business really going to be once the pandemic sort of shakes out, which we've gotten to now. But at that point, it was a little uncertain. And that cut both ways. There were businesses that were really suffering because of COVID. We can think of great examples there, and trying to think about what would this business do if it weren't for the negative impacts of COVID. But there were some businesses, and we were fortunate to work with some that benefited from it. So we sold a distribution business that focused on building products. Everyone was staying home and doing projects in their backyard, building fences, building decks, adding to the value of their home. Their business actually benefited from COVID and the lack of travel and the restrictions that were going on. When we went to sell that business shortly after, business owners were saying, well, it's great that you had such a great year during COVID or two, but what are the ongoing businesses once that demand, artificial demand sort of settles out? And so largely we've gotten through that. Now we've had a few years of post-pandemic normal business activity. So that question of what's the ongoing earnings capacity of this business to some degree has gotten a little bit less significant, but that's always a question that buyers are going to have. Am I looking at a period of time that's abnormally beneficial for something that's helping the business in the last 12 months that isn't going to be sustainable going forward? And that's going to be discounted if it can't be shown to be sustainable. Around structure is, buyers are always trying to hedge their bets. Like they would rather have some piece of the purchase price be contingent on the future performance of the business. And I think some of your prior guests have touched on this, but that's sometimes that comes into a category of what we call earnouts, right? It's contingent consideration, purchase price that we're not sure what it's going to be because it's dependent on the future performance of the business. Sellers typically don't like earnouts because they want to be paid at closing the value of the business that they've created. And business buyers are trying to, again, hedge their bets and say, well, I'm willing to pay you more if the business is going to do what you think it's going to do. I'm not sure it's going to. So I want to have some of the purchase price, and that sum could be 10%, it could be 50%. I mean, we're trying to keep it as low as possible and have as much in cash at closing as possible. But buyers may say we want to have some part of it, of the purchase price, be dependent on the future performance of the business. Where I find that earnouts seem to be best received is when there's a piece of the business that the seller and the buyer have very differing views on. The seller is very bullish about it. So it could be a new customer that the seller knows is going to really be a home run, and the buyer's not quite so sure. The seller might be willing to have a limited earnout based on the performance of that particular customer or for the business during a very short period of time, because they know it's going to come to fruition because they've seen the history leading up to that. And so that feels like a safe bet for them. We, again, try to have earnouts be as little as possible. And when we do feel like when our clients decide they want to have an earnout, we try to keep it as short as possible, as simple as possible, and as easy to calculate and not have a lot of questionable expenses or the ability to manipulate it during that earnout window. So an earnout by definition isn't necessarily a bad thing, but making sure it's well crafted and as tight as possible and as short as possible is the advice I'd give.
Yeah, that's great. That's great and great advice. And so yeah, with that, as we kind of wrap this up, what would you say if you could think, what's like the one, if you had to boil it down to one, what's the one piece of advice you give to that business owner that's out there that's saying, yeah, I know an exit's coming, it could be somewhere in the future. What's that one piece of advice that you'd leave them off with?
I think it's really proactively think about an exit and not have it be something that is shoved to the side and avoided, and we'll get to that later. Don't put it off. Regardless of where you are, if you've just started your business, you should be thinking about an exit. If you have been owning your business for 40 years, you should be thinking about an exit. You should always be thinking about an exit. Creating value in the business, in addition to the value that it creates for the business owner on an annual basis, there's so much more value to be created in the actual entity itself and that final exit in most businesses than would be there would be much more than the accumulation of the cash flow in any given year over a period of years. And so thinking proactively about an exit, thinking about the risk, like we talked about earlier, that might be perceived in my business and reducing that risk. And that involves building out a management team, having diverse customer and vendor relationships, and really just the last piece we haven't touched on is the annual budgeting process. But having some fundamental practices in place to set annual goals and to track them and then to report out on them is another thing I think is really helpful for business owners to do.
Great. Yeah. Thank you. Yeah. And yeah, I mean, you're a wealth of knowledge, and that's why it's exciting to have, great teammates like yourself here at Transact Capital. So, and there, like you said, there's a ton of stuff we didn't cover. So what's the best way for people to get in touch with you?
Reach out transactcapital.com or LinkedIn, Brabrand, Jonathan Brabrand, or I have a website, jonathanbrabrand.com.
Awesome. Great. Yeah. Well, thank you, Jonathan. I appreciate it. And yeah, again, author of the $100 billion exit. So great book. I really enjoyed it and really enjoyed this interview. So thank you.
Thank you.
Transact Capital presents Banking on Your Business with Jacob Robertson.